Very warm good evening to everyone, and we are on the verge of what I believe on the closing aspects of this subject, corporate and economic laws. And I'm sure by this time you must have gained a lot of knowledge. But yes, apart from knowledge, very important to learn things, understand the concepts and how do you relate in exams. That's more important. So I believe you must be developing those thought process in your mind regarding how to connect the dots of the various sections of this corporate law, and then answer to all these case studies based scenario or technical questions which require a lot of application of mind. So that is what you have to develop, friends. So today's session is on the topic of miscellaneous provisions under company law. You would wonder that why we need to study all these miscellaneous provisions. First, because these are small aspects which are important from the overall perspective of company law and the operations of company. If these sections were not there, probably the whole company law would not be complete. I mean, the whole cycle of a company would not get complete. So that is why all these small provisions are there, which talks about specific areas, specific transactions, specific situations. So that is one aspect from the practical point of view. The other aspect from the exam point of view, which is more relevant. I think, friends, again, when you see the overall question paper and understand the trend, if you analyze it properly, I always suggest that strategically, you should always concentrate on these small topics which are independent. You read only 5 sections and you cover one topic, and where there is a probability of question being asked. So as a strategy, I would always focus on reading these subjects, these topics thoroughly, because these are small areas and we don't expect a lot of technicalities in these areas. And because normally these topics are ignored at the end of the day. So if you tend to focus on these and then concentrate on the other topics normally, I think you have a fair chance of getting good marks. That's one of the strategy which I had followed 25 years back when I had appeared for CA final exams. I believe that still persists. So friends, the miscellaneous topic covers topics in the area of valuation, dormant companies, strike of companies, nidhi companies, government companies, fraud, maybe something on NCLT rules. So a lot of small areas, as I mentioned. So focus would be on these topics. In due course of time, we'll discuss some other aspects also. So we have dormant and strike of companies, which is very relevant. And if you see the cases which are filed in NCLT, you will find a lot of cases being filed for strike of companies. And there are a lot of hearings which are done for strike of companies. Registered valuers, relatively a new concept. Again, last 3 years, I think it's just been 3.5 years since this concept had come in. And I believe that it got a lot of relevance in the company law, as well as for practicing chartered accountant, and as well as opportunities in this area. So friends, I myself being a registered valuer, I can vouch for it that in the last 3 years, a lot of things have changed and we get many opportunities for valuation exercises. Very exciting field, and truly you can explore this particular option. Then the government and nidhi companies, specific type of companies, we all should be aware of nidhi companies. What I mean to say aware, when I say aware, I think you will come across many companies, ads in the newspaper, hoardings on the road, and especially in smaller areas, you will find these nidhi companies floating various type of schemes and raising funds and from the members. So as a normal citizen, I think we all should be aware of what is nidhi company, what is a chit fund company, what is a small microfinance company, what is NBFC, what is bank. I think we should be clear with the differences between all these financing institutions. And what is the difference between all these? What is the common area? What is one which can do, which are governed by RBI and which are not governed by RBI. So, but here we'll not focus on the overall perspective, will focus purely on the Nidhi companies. And then 447, I think in many sections, this 447 is quite frequently linked. So anything which is not complied, which involves the word FRAUD, fraud, I think everywhere it is linked to this 447. So quite prominent in the overall company law, this 447. Therefore, though a very short section, 447 and 448, 447 is the major one, which only talks about penalty part, but still quite relevant. So friends, these are the topics which we are going to cover. So let me start with the first topic, that is the registered valuer part, I think. But yes, the past trends have shown that there is a mixed nature of question. There are certain direct questions, certain indirect questions. That means case-based scenarios are also asked. So you should be aware of certain concepts, the linkages of the section with other section, and obviously direct questions which are very easy to answer. So coverage would be 4 to 6 marks, that's for sure. We expect one question definitely to come out of this topic. So let us start with the concept of valuation, friends. As I mentioned that since 5th February 2019, to be very precise, I think from that date, these sections were actually implemented and we had the valuation rules being notified. So 5th February 2019, any valuation which is done under this law, company law, it says that you have to refer to section 247 and 248 and so on. Then only you can undertake the valuation exercise. So for every company, we need to refer to 247, 248, and along with that, the valuation rules. And these two sections only and the valuation rules have opened up many opportunities for chartered accountant. And truly a different perspective is given to how the funds are being raised, on what logic the funds are being raised, at what price the funds are being raised. When you see the startups raising funds at such high price, that how that high price is justified, legally, logically, I think everything is governed by these valuation rules. So the word which we have to remember as a registered valuer. So we'll be talking of that individual, chartered accountant plus a registered valuer. So the natural question comes in, can a chartered accountant be a registered valuer? The answer is yes. Second question comes in, can a chartered accountant practice as a registered valuer? The answer is yes. So the answer is yes. So we are talking of a person, friends. If you see the overall perspective, friends, in terms of valuation, you'll find that the need arises because of various transactions and compliance of law. Two reasons, transactions and compliance of law. So if you talk about transaction, there's a merger equation, there's the issue of securities, IPOs, preferential allotment. Then there's the conversion of securities from debt to equity, from convertible preference shares to conversion of warrant to equity shares. There are a lot of convertible instruments. Especially if you talk of the current scenario, all these startups, friends, let me tell you, all these startups raise funds in the form of all these convertible preference shares and convertible debentures, which are converted into equity shares at a later point of time. The instruments are known as CCDs or CCPS, compulsory convertible debentures. So there is conversion which happens, and when the conversion happens, there is a requirement of valuation. Takeover, there's a capital reduction, buyback happens at a particular price, then the ESOP shares are being issued to employees. You know, in income tax, there is some tax treatment of ESOP, how that tax treatment will come, what is the share price at which the price will be sold. That means for a private limited company, then how that gain will be calculated, how the intangibles are valued, on what basis, what is the criteria of valuing that intangible. Then Ind AS, you must have studied Ind AS fair value. A lot of places where there's a fair value basis, fair value accounting. So in those scenarios, we need to account for the fair value. Then a requirement of Companies Act, which we are going to discuss, NCLT. There are various court which orders certain kind of valuation under specific situation. During arbitration, valuation may be there. Under SEBI law, there are mention of valuation. Under IBC, we'll again discuss in next month that there is a valuation requirement. FEMA regulation talks about valuation. Income tax rule, Rule 11 UA, very important, Section 56 other income and Rule 11 UA, when shares are issued, for especially in case of unlisted companies, when shares are issued, at what price they are issued, how those gains will be calculated for transfer of shares in a private limited company. Transfer of shares in a private limited company, that for that probably we need evaluation. Equity research, dispute, dissolution. Before 2019, there was no such requirement under law which was prescribed, especially in company law, to be done from a registered valuer. But post, the company law talks about it. And in due course of time, we expect that all other laws will actually culminate, will focus on this word of valuation from a registered valuer. So the regulatory framework, if you talk about the law, the Section 247 of Companies Act, which became effective from 18 October 2017, but actually got implemented from 5th February 2019. There was a delay for 1.5 years for certain reasons, but finally it saw its picture painted red. Then we have the registered valuers and valuation. And then there are the valuation standards. So today the valuation standards are not issued by government, but wherever we have to refer, so they have mentioned that you can refer the ICI valuation standards or the international valuation standard. ICI valuation standard or the international valuation standard. So as of today, if we talk of the provisions of registered valuer, that which are the laws which specifically mentions that registration or valuation has to be done from a registered valuer. Not every law has enforced that, remember friends. At the current context, there are only few laws which have mentioned this. The Companies Act, the SEBI, then we have the IBC. These three sections do refer to word registered valuer, registered under Companies Act. So every act referred to a registered valuer, but registered valuer where? Under the Companies Act. Then under FEMA, there are certain guidelines which talks about registered valuer. But other law do not mention the word registered valuer. They do not mention it. But going forward, we expect that there will be a change in the law and there will be a mention that report has to be taken from a registered valuer. Especially if we are talking about company law, corporate law, you will find that there are various sections which talks about valuation. Now you should be aware of these sections because if there's a case study scenario, then you should be aware that okay, this section talks about registered valuer, and then there could be linkage to Section 247, which we are going to study. So we should be aware of the provisions. Now, 62, obviously, you must have studied at your inter level, but then 62D is one of the major section which actually mandates the requirement of valuation report whenever the company is issuing further share capital, further shares. So that means whenever the company is raising funds through equity shares, then there is a need of valuation from a registered valuer. The need may be in case of issue of shares other than cash also. So let's say when there is a unsecured loan converted into equity, or we are taking a property from the promoter director and then issuing shares against the property. So there can be issue of shares against other than cash also. So whenever there's a raise or increase in the share capital of the company, not the authorized but paid up, then there is a need of the valuation report. Then just wondering whether who are the students who have logged in. Can we have just mention the students who have logged in? Yeah. Then under 232, friends, merger and acquisition. I think very relevant section for all of you and quite practical also whenever you get into the world of the corporate world, be it practice or job also, then you will find this section 230 or 232 quite relevant, and especially in the investment banking, merger acquisition, or when you're dealing with takeover, then this particular, Jay, okay, Jay is there. Then this particular section is quite relevant. So whenever merger happens, then there is a need of valuation report of how many shares to be issued. You must have studied in a financial management, strategic financial management topic, where you have to calculate those exchange ratios. Exchange ratios, how many shares to be issued for the target company, how to calculate that exchange ratio, though that is financially calculated, but here, okay, Aniket is there, right? Shailendra is there. Good evening, good evening. Great to have you all people out there. So in your financial management, strategic financial management in merger acquisition chapter, so whatever methods have been prescribed, probably we may not follow those methods out here, subject to the valuation standard. But yes, we know that we need to calculate the exchange ratio. So that is must in 230. Then 281, we have studied in the liquidation. A report is prepared by the liquidator valuing the asset. So when they need to value the assets, we need a valuation report from a registered valuer. So that is 281. Apart from that, friends, there is a requirement under, let's say, section 42, which is again private placement of shares. Very important section. Again, when you enter the world of practice, you will find that there's a very important section. Chart accountants, normally there are out of 10, if 5 go into practice, and out of 5, only 1 goes into the practice of corporate law. I mean, even 1 is a fair number. But yes, 42. And then you must have heard about sweat equity shares. Now, how do I issue the sweat equity shares? At what price the sweat equity shares are issued? So that means in that case, I need to value those equity shares, value the sweat which is contributed by the director to understand how many shares to be issued to the director in the view of the sweat equity shares in the sweat contributed by the director. So again, in that case, valuation report is required. So 42, 62, 230, though there are only 2-3 sections which talks about valuers, but then quite important in terms of transactions, because these are frequent transactions which are happening on a daily basis across the country. So you will find that company is growing. When the company grows, it needs funds. When it needs funds, you know that there are only 2 modes of raising finance in the world, equity and debt. So it cannot be 100% equity or 100% debt. It has to be a combination, ideally, though it is choice of the company. So whenever they raise funds, through equity, you need a valuation report. Under IBC, which we are going to discuss in next month about the IBC provisions, whenever valuation is done under IBC, valuation report is to be taken. We will not discuss that. So let us focus on the section 247.1. So I have given you a brief framework about the need of this valuation. Therefore, I would request that you concentrate on this particular section, only 2 sections, but practically a good opportunity. So 247.1, they talk about that whenever valuation is required in case of shares, stocks, property, debentures, security, goodwill, any other asset, then we need a valuer. So the valuation will be done by a person having such qualification and experience. That qualification and experience is given under the valuation rules. then he should be registered as a valuer. He should be registered as a valuer. He should be a member of an organization recognized. Now, which organization are we talking about? Is it ICI? Is it ICSI? We'll understand. The manner and the terms and conditions of registration as may be prescribed, again given in the rules. And very important, you should be appointed by the audit committee if it is listed or wherever required. And if there's no audit committee, by the board of directors. By the board of directors. So this is section 247(1) talks about the requirement. Now, subsection 2 talks about a very simple process. We'll go back to 247(1) again, understanding the conditions, but let me complete the whole section. He makes an impartial, true and fair valuation of any assets which may be required to be valued. So it has to be a true and fair valuation. It has to be true and fair valuation. And when doing the valuation, he must exercise due diligence while performing the functions as valuer. Has to make the valuation as per the prescribed rules. And when we see the rules, it talks about the valuation has to be done as per valuation standard. So ICI valuation standard. And very important, he should not undertake valuation of any asset in which he has a direct or indirect interest or becomes so interested anytime during a period of 3 years prior to his appointment or 3 years after valuation of asset was conducted by him. So that means if I am undertaking an assignment of valuation, we should ensure that we should not be related to that company 3 years prior. And once I do the assignment, I should not undertake any activity 3 years post, direct or indirect. I should not have any interest. So that again limits our area of working. Very much required. I think we all have this limitation. Even when we are a stat auditor, we cannot engage ourselves into different other services. So similar way, we should not be engaged in other services, including stat audit. So if you are either you can do the stat audit or the valuation. Now, friends, important part. Punishment, damages, PD. Punishment and damages. Both. Punishment, we all understand, a fine of 25,000, maximum 1 lakh. Plus an imprisonment of 1 year with a minimum fine of 1 lakh and maximum if the contravention is done with the intention of fraud. That has to be proven, obviously. We can never say what is fraud. It is always to be proved that this fraud has been committed. That the intention should have been there. Malified intention should be proved. Not only on the basis of transaction, the intention has to be proved. Plus, remember, he is liable for damages. Damages to what? This is important from exam point of view. Because I think this is only one provision which talks about damages, and that too, damages where you will be liable to refund the remuneration which you have received from the company as a part of the assignment. Plus, you have to pay damages if there is a harm which is being caused to the company because of your incorrect or misleading statement made in your report. So when you submit your evaluation report, if there is a misstatement on the basis of which somebody has relied upon, then you are liable to certain damages. So this is the punishment and damages. Okay, so let me have certain few questions. So when a registered valuer is convicted under 247, then is liable to pay what? So is liable to pay the refund of remuneration, pay for damages. Yes, challenge India, I will come to that. Both A and B. So the correct answer is yes, both A and B. So Jay, when you see the requirement here, direct or indirect interest, he should not undertake valuation where he has direct or indirect interest. So which means that if you are a stat auditor where you have a direct interest, you should not take a valuation assignment. Jay, I hope it is clear. A valuer under this section will make impartial, true, fair. I think very simple. Everybody can answer it. It is impartial, true, and fair valuation. Quite simple. The board of directors of Tim Pro Limited proposes to appoint Mr. Nirala, an individual, as the valuer for carrying out the valuation of immovable property. In the given case, the board does not have a right to appoint the valuer. It is against the said provision. Okay. Now, an individual as the valuer. Now, question is whether that is correct or not. So, simple answer would be that yes, the board can appoint a valuer, but then that valuer should have the requisite qualification and experience and should be registered valuer in such manner under terms and conditions as may be prescribed. And if it is a listed company, then it should be appointed by the audit committee. And if it is not listed, then the board can appoint it. That is how you have to give the whole answer. 247.1. You have need to refer 247.1 and 2. Okay, now coming to the question of which institution, where do I need to register? What is the requisite qualification and experience which is required for getting into the world of valuation and become a registered valuer? So the rules mention all these things. The rules define the requirement and the requisite details. So when you refer to the rules, I will give you the brief framework so that you understand it properly. Let me just open one slide. Yes, friends. So as a chartered accountant, let's say you are a chartered accountant. So when you want to see whether you become a registered valuer or not, you refer to the rules and you find that, yes, a chartered accountant is eligible to become a registered valuer, provided, first, I'm taking one example, he has 3 years of experience. He has got 3 years of experience. From the date of getting your COP, you should have 3 years of experience. Now, once you have a 3 years of experience, what you need to do? You need to register yourself. You need to register yourself in one of the RVOs. RVO is Registered Valuer Organization. Registered Valuer Organization. RVO is nothing but Registered Valuer Organization. Example, ICAI RVO. ICAI RVO. ICSI RVO. ICSI RVO. ICMAI RVO. So in all, in India, there are about 18 plus, must be 20 RVOs which are registered with whom? So you need to register with RVO, and RVOs are governed by IBBI currently, Insolvency Bankruptcy Board of India. So the IBBI's major job is towards insolvency, but they have been given additional responsibility of giving recognition to RVOs. So you need to register yourself with RVO, and RVO is recognized by IBBI. Thereafter, you need to undergo a 50-hour training program. 50-hour training program conducted by RVO. 50-hour training program conducted by RVO on the area of valuation. So that's a separate 50-hour training program which goes on for a month or 2 months, so held normally on the weekends. I have taken classes on behalf of few RVOs. So you have to undergo a training program, a 50-hour training program. Thereafter, you need to appear for a valuation exam. You have to appear for a valuation exam, which is conducted by an agency, separate agency, NISM. NISM. So there's a separate agency which conducts this exam. This is an online exam. You have 2-hour online exams, multiple choice with negative marking, and you have to get 60% marks to pass that exam. You can appear once in 3 months. So once you clear the exam, you are enrolled as a member of RVO and registration certificate is given by IBBI. So you enroll yourself with RVO. The RVO will refer your name to become as a registered valuer to IBBI. And then IBBI will grant you the certificate that you are a registered valuer. You are a registered valuer. This is the structure. This is the whole framework of becoming a registered valuer as a chartered accountant, having 3 years of experience. I hope this structure is clear to you. So when you talk about the authority, IBBI is the authority, which has been specified by the government. Now, asset class, remember friends, when we become a valuer, registered valuer, the registered valuer is classified under 3 categories. You become a registered valuer of land and building, plant and machinery, and SFA. Yes, non-CAs, again, we'll come to the specific qualification. We'll refer to this qualification which is required. And the third category is SFA. SFA is securities and financial asset. Securities and financial asset. So as a chartered accountant, we become a SFA valuer, securities and financial asset valuer, not a land and building or plant and machinery valuer, because we don't have that technical expertise to become a land and building and plant and machinery valuer. So therefore, we become a SFA valuer. Now, what is the job of SFA valuer? The job of SFA valuer is to value financial assets, like when you want to value equity shares, preference shares, debentures, we need SFA valuer report. So as chartered accountant, we can give the valuation of financial asset. Yes, only after 3 years, not before that, Jay. We need 3 years of post-qualification experience. So there are 3. Yeah, experience can be in any field. You need to be a practicing chartered accountant, so your experience can be in any field. Right? Okay. Now, what is the eligibility for becoming a registered valuer? First, you should be a member of RVO. Then your name should be recommended by RVO to IBBI. You must have passed your valuation exam within 3 years. So you register yourself with RVO, and within 3 years, you need to pass the exam. You are not a minor, unsound mind, possess the qualification experience, we'll come to that. Person resident in India, fine. Not convicted of an offense punishable with imprisonment for a term exceeding 6 months or an offense involving moral turpitude and a period of 5 years has not elapsed from the expiry of sentence. Then provided if a person has been convicted of any offense for 7 years or more, he will not be eligible to be registered. And plus, you should not have been levied a penalty under Section 271J of the Income Tax Act. J of the Income Tax Act. Then, remember, when we talk of a registration, so you can register yourself as individual or in the form of partnership firm or LLP. So you can create a partnership firm of valuers known as a registered valuer entity. Known as a registered valuer entity. Known as a registered valuer entity, and you can register your RV with RVO. So the objective of that company should be for the objective of providing valuation services, and all partners and directors should not be ineligible under the previous individual members qualification criteria. Then 3 / all partners, all directors, whichever is lower of a partnership firm or company are not registered valuers. Remember, the word starts with no. And none of its partners is a registered value for the asset class. Now coming to the qualification, as somebody was asking. As a qualification, postgraduate degree, diploma, minimum 3 years of experience. Bachelor's degree in specified discipline from a university, 5 years of experience. Membership of a professional institute like ICI, minimum 3 years of experience. So today, even an MBA can do the registered valuer course. MBA also, because that is recognized. Having a 3 years degree, 3 years experience, he can become a registered valuer. And if it's a bachelor degree, which is not yet clear which bachelor degree, especially in SFA category, but for MBA finance, he can become a SFA category. But for plant and machinery, land and building, he can be a graduate. So any graduate in any engineering division, 5 years of experience, postgraduate 3 years. Graduate in civil, 5 years, postgraduate 3 years. For SFA, it is purely either MBA or member of ICA, ICISI or ICA CMA. So this is the requirement. This is the requirement. The syllabus, the will be designed by IBBI and conducted by NSM and so on. So not at all required. Okay, let us come to the questions part. Who is eligible to become a registered valuer? One is not minor, is committed by RBI, is a valuer member of RVO. So RVO, remember, registered valuer organization. So he should be a member of RVO, plus his name should be recommended by RVO. To whom? To IBBI. Until unless your name is not recommended, you cannot become a member. So all of the above is the correct answer. Who cannot be eligible to be a registered valuer? Has been declared of unsound mind. Has been convicted under Section 271J of Income Tax Act. An undischarged bankrupt. All of the above. Obviously, all of the above. Simple questions. If you have read it once, you will get it correct. All these MCQs do not require multiple reading. Now remember, your registration will be granted. Your registration will be granted when you possess the required qualification. And we comply with the laws, take adequate step for redressal and grievances, maintain records for assignment for 3 years. Again, I think not relevant from exam perspective, but what is important, just wanted to mention that you have to maintain the record for 3 years. That may come in MCQ. That's all. That if you have to keep the records of valuation, you have to maintain for 3 years from the completion of such assignment. This is important, friends. This is important. The conduct of the valuation. So rule number 8 talks about that valuation will be conducted as per valuation standard mentioned in rule 18 or internationally accepted valuation standard. And rule number 8 also talks about that if required, the registered valuer may obtain inputs from another registered valuer and he has to disclose the relevant details of that registered valuer in his report. Now you would question, sir, why do I need a support of other valuer? For example, if I am valuing the shares as a chartered accountant as a SFA valuer, securities and financial asset valuer, if I am valuing the shares, on basis of NAV, net asset value, then I may require the valuation of the asset. An asset includes land. Let's say the asset includes land. I need to have a valuation of the land. So how do I take the valuation of land? So I will take a report of the valuation report of a land and building valuer. On that basis, I will calculate the fair value of the asset. And on that basis of fair value of asset, I will calculate the net asset value per share. So in that case, I am engaging the services of other valuer for valuing the land and building. Same way could be the plant and machinery. Now, rule number 8 also talks about the most important angle. It gives you an insight on what is included in my valuation report. Rule number 8. what is included in my valuation report. So friends, why this subject of valuation when today you are not still becoming a chartered accountant, yet to become a chartered accountant, then wait for another 3 years, and then actually get into the world of valuation. Friends, it is important that when even you are doing an internal audit or a stat audit, or you're doing compliance work or due diligence work, you should be aware that yes, there is a requirement of law. And what is the law? What does law talks about? So it gives you a holistic picture. So therefore, it is important to understand the important aspects of this valuation world, the rules and the section. Now, contents of valuation report, friends. Very important aspect. So let's say, for example, under section 62, when the company is raising more funds, it has to issue shares. So the question comes in, at what price the shares are issued? Now, the other few questions which should come into your mind, let's say I have given a valuation report, let's say a chartered accountant or SFA valuer gives the value of the shares as 100 rupees, 90 rupees. On what basis do I calculate? So obviously, I have to refer to the valuation standard. And the valuation standard talks about that there are 3 ways of valuing the shares. 3 ways. You must have already studied in your strategic financial management. 3 ways are very simple. The income method, that is the DCF. If you have studied that subject, free cash flow method, I hope you must have gone through that free cash flow method. The income method, discounting it for the next 5 years. The future income discounted cash flow method for the future, calculate the free cash flows discounted by appropriate discount rate, and then calculate the value of business. Calculate the terminal value, calculate the value of business. So that is one simple way based on the future projection. The second is market method, where you can apply any market multiple to value any company. I think market multiple is very common. You should be aware because these are standard terms which are used. Even in company law, they can use this term. Though the calculation may not be required, but at least they may use this term, market multiple or market method. So market method is nothing where you follow a market standard. You must solve a few questions based on PE ratio, PE multiple, EBITDA multiple, enterprise value calculation in financial management. And third is purely based on the asset method, the value of the fair value of the assets, the NAV method, fair value of the net asset. Based on that, we are trying to do that calculation. So once you do the valuation as per the valuation standard, obviously there are other methods prescribed for startup, for intangible, not going to technicalities. But question comes in, how do I value and what basis I prepare the report? So the structure of the report will be giving the background information of the asset which you are valuing, let's say the shares. So you are valuing the equity shares of the company. Purpose of valuation as per section 62, that is the purpose of valuation. Maybe section 230 where I have to calculate the exchange ratio. For that, I need to do the valuation of acquiring company, valuation of target company. That could be purpose of valuation. Who is the appointing authority? So the board of directors are the appointing authority. Identify of the valuer, my identification as a valuer. I will give my details, my registration certificate. And if any expert is involved in the valuation, I would refer their name. Any conflict of interest, so please give that disclosure. Very important where you appointed, what is the valuation date and what is the date of report. Maybe valuation date is 1st April 2022. I am giving the report as of today. But the valuation is 1st April 2022. What are these inspection and investigations you have undertaken to do the valuation? What is the source of information for you? What are the documents on which you have relied upon for doing the valuation? So I would call out for the company's balance sheet for the last 2 years, forecasted balance sheet, how to justify that forecasted, any other information of competitors, information of any listed company, any market data, and my assumptions which I have used for doing the valuation, my calculations, my process, I need to mention that. And finally, the conclusion part, which will come at the last, where I will mention the fair value of the shares. And obviously, as a standard professional, I would always give the KVS limitations and the disclaimers, which is always a part of any report. So if you want to find out any valuation report, you can go on the net and search for valuation report of ABC company, any company. You may come across certain valuation report which may be available on net. So that will give you an idea about what are the contents of a valuation report. As a RVO, the registered value or organization, that is a Section 25 or a Section 8 companies. Section 8 company. So they have to classify themselves as a Section 8 company. Then they should be registered in the society or set up as a trust. And thereafter, you can become an RVO. Yes. Can you file a complaint against a registered valuer? Yes, we can do that. And that could be possible. You can complain before the authority in person and by submitting a fees of 1,000, and then the complaint is filed. And if there is any contravention of the rules, then as per Section 469, you are punishable. Let's take a question, a simple question. Mr. Bhola, director of Bhandari Limited, entered into an arrangement with his friend and acquired asset on the name of Bhandari Limited by passing resolution in general meeting. The notice for approval of resolution of the company included the particulars of arrangement along with the value of the asset duly calculated by a registered valuer. So there was a value of asset, maybe land value. Later, the board discovered the loss arising out of incorrect statement in the report. Is the valuer liable to be convicted for the incorrect statement given in the report made with an intent to defraud the company or its members? The answer is yes. So we have read 247. Where it talks about that if there's an intention to fraud, there is a case of punishment and damages. So that was all about valuation, friends. Any questions arising on your mind? Please raise it. Any thoughts? Any questions? No. So two things which you have to remember, just to recall, friends, two things which you need to understand. First, 247, 1, 2, the requirement. It will be done tomorrow. We'll take all the 3 notes and we'll upload it. . So I was waiting for this class to get over and then I'll upload all the 3 notes. Is it fine? Yes. So 247.1.2 along with certain rules. Remember the basic qualification. No, not required. Not required, Bhumi. I don't think you need to require to remember the rule numbers. Even I don't expect any detailed question on the rule part except for the basic qualification criteria. That's it. We just need to remember the qualification criteria. So if you are thorough with that qualification criteria, I think it's good to go. More important is you should be aware that yes, there is a requirement of registered valuer. The basic provision talks about appointment by the board and the consequences if the rules are not properly followed. And I've given you an insight of wherever the sections, what are the sections which talks about valuation. So maybe if there is a compliance question where it talks about what are the compliances to be done for doing a merger acquisition, then you need to mention one point that yes, apart from this, there's a requirement of taking a valuation report also. Great. We can do more questions, MCQ based, maybe later on. Now coming to section 248. 248. Now remember, in terms of valuation, rule number 8 is important, the contents of the valuation report. There may be a question which may talk about that in the valuation report, some of the elements are missing. So you should be aware what are the elements of the valuation report. So rule number 8, which will talk about valuation, contents of the valuation report. No requirement of understanding the valuation standards because that is too technical. Valuation standards, not at all a requirement. Structure should be very clear. What is IBBI? What is RVO? Registered valuer, different categories. That is all. Okay, coming to this particular aspect of removal of names from companies from the register of companies. When I talk about removal of names, does that mean is it the end of the company? Or what difference is it from winding up, voluntary liquidation, and removal of names from the companies? As a company, what option should I choose? As a consultant, what option should I advise to the client that whether you should remove your name or you should go for liquidation or you should go for winding up? So I think the new company laws brings in these terms which I think, again, from exam perspective and practically, you should be thorough in that. And these are small aspects. Just learn those. And I'm sure one question will be asked either from removal, dormant, voluntary liquidation, and winding up and insolvency. Insolvency is obviously there, but from these topics, one question which could be related to all these three. Yes, Shalinji, plant is acquired other than cash from director, then registered valuer report is required. Yes, it is required because under 62, it is shares being issued other than cash. So the consideration is plant and machinery and you are issuing shares to the director because he has contributed his plant and machinery other than not the cash. So then valuation report is required. 2 valuation report, 1 valuation report of the plant and the other valuation report is the valuation report of the shares. So there will be two valuation reports. So what is the difference between winding up and strike off? Let us clear these concepts. Winding up, it's complete closure. The whole company goes. And restoration is very less likely, except under 356. Section 356 talks about restoration, where they found that winding up is done for ABCD purpose. Then only it will be restored, otherwise very less chances. While strike off, restoration possible anytime till 20 years. So strike off does not clearly gives a complete closure. It is a closure, but with a caveat attached, anything can happen in 20 years. And it actually happens. There are cases where companies have been restored based on certain applications by certain people, certain person, where they found that the company should not have been striked off because there is certain amount of assets or liabilities which are there. Let us see. The first thing which we have to understand is the modes of strike off. So the company can be striked off only by two modes. One by the registrar, another by the company. Now you would be surprised that, sir, whether company on its own can go and strike off? The answer is yes. Obviously, somebody else can. That power is always there with any authority, but somehow it looks very, very vague, or at times look not digestible, that how can I come and say that I want to strike off? So the power of registrar, direct question or certain important things which you have to remember so that you can always solve the indirect question. So the power of registrar, wherever they have a reasonable cause to believe. Now, suddenly we have a change, from whatever you have studied in valuation. There is now more interpretation of the words, the technicalities, reading between the lines, and law. Valuation was more of a standard process, and then more on the technical, that how to do valuation and the limitation of valuer and those all things. But here now we are understanding the law, the words. Whenever you have a reasonable cause. Now the reasonable word is never defined under law, remember. Company has failed to commence its business within 1 year of its incorporation. Very important. You must have studied in your law, even in this law, where you have to give a declaration of commencement of business. And suppose you have not given that, and the ROC comes to know that, there is no such commencement certificate which has been given to you. Probably there is something missing. And that something missing is that the company may not have started its business within 1 year of its incorporation. So in that scenario, there are chances that the registrar may strike off your name. So 1 year is a sufficient time to start your business, right? Or the company is not carrying on any business or operation for a period of 2 immediately preceding financial years, not necessary from the date of incorporation. And you have not made an application for obtaining a status of dormant company under Section 455. So you have not applied for being a dormant, but then you're not able to do operations for the last 2 financial years. So one is 1 year from incorporation date. The second is 2 years to any financial year. Subscriber to the memorandum have not paid the subscription amount which they had undertaken to pay at the time of incorporation of the company, and declaration to this effect has not been filed within 180 days of its incorporation under Section 10A. So under Section 10A, there is a requirement that you have to file a declaration that, yes, I have paid the subscription amount. It may be get certified by a chartered accountant, the amount has been received in the bank account, and the process is complete. Now, you would always wonder practically, subscriber to the memorandum, when I've already subscribed to the memorandum, do I need to pay that amount again? Friends, remember, when the company is incorporated, there's a memorandum which is prepared. That memorandum has a table where there is a name, the amount, and the number of shares is written against that name. And the name which is written under that table as subscriber to the memorandum, they are basically designated as promoters of the company. They are designated as the promoters of the company who had initially come together to promote this company, form this company. But when they write the number or the amount, it does not mean that they have paid that money. They have paid that money. It does not happen like that. Remember, the company has not been formed yet. How can you pay that amount? The company has not been formed yet. How can you pay that amount? So they promise to pay that amount. Remember, they promise to pay that amount. That is why they are known as subscriber to the memorandum, that they promise to pay the amount once the company is incorporated. So when the memorandum is filed, they are promising that, yes, they will pay this amount. Once you incorporate, give the incorporation certificate based on which I'm going to apply for the PAN, and on the basis of which the bank is going to open my bank account. Once the bank account was opened, the first money which will come in as a subscriber, so I will give that amount in the bank account, and thereafter I will file a declaration, and that declaration will be submitted to the ROC. Just 1 second, please. So remember, that is the subscriber to the memorandum. Then the company is not carrying on any business or operations as revealed after the physical verification carried out under subsection 9 of section 12. So there are visits by the ROC for carrying out the physical verification. And today, I think it is very important looking to what has happened in so many Chinese companies which were created where there was no such physical existence, and there was a certificate being issued by many professionals verifying that the company is there, office is there, but actually they were not there. So I think there has been certain changes in the law also currently with respect to the physical verification part. So when there's a physical verification was carried out, that it means that the company is not carrying on any business or operation. Then a notice will be sent to the company under STK1. That's a notice form which is sent, and to all the directors of the company of his intention to remove the name of the company from the ROC, and requesting them to send their representation along with the copies of relevant document, if any, within a period of 30 days from the date of notice. 30 days from the date of notice. Very important. Again, relevant for MCQ, relevant from MCQ part. Provided, very important again, this is a direct question, 4-mark question, 5-mark question can be asked. Which companies cannot be removed? Which company's name cannot be removed? Which company's name cannot be removed? The following category of companies shall not be removed. First, we all understand listed companies. You can only suddenly remove one day. Listed company can go away. It cannot happen. So very natural. You can remember this. So not at all a confusing point. But there may be a situation where the companies which were listed, but now they are delisted because of non-compliance of law. The SEBI or even the stock exchange. The stock exchange, BSE, NSE, they can, because of the non-compliance of the listing agreement, they can remove a listed company name, not a name, but they can delist any listed company. So if once the company gets delisted, the ROC can remove their name. So the answer is no. Delisting happening because of non-compliance of listing regulation or listing agreement, then that will not lead to removal of the name. Third is vanishing companies. I think the company law sections are such that they do vanish very immediately once you are off your topic. And very difficult to remember things, recall things, learn things, because in exams, we all understand that you need to write down, remember so many things. We have all gone through that pain, but yes, there are many who have gone through this pain and came out with flying colors. And I hope you will also do that. So let all the provision don't go vanish from your mind. It's only about, different point of time, striking. Consistency is the key. That's it. Consistency the key. 0.01% improvement every day will lead to much powerful result in comparison to 1% improvement in every 2 months. The compounding effect, right? Anyway, being a chartered accountant, we should always be aware of the compounding effect. So vanishing companies, which we are going to discuss. Companies where inspection investigation is ordered. Remember, inspection investigation ordered 210, 212, and then the report is the such order are yet to be taken up, or where completed, the report has been issued under 223, but the report has mentioned about prosecution, but then no prosecution has been taken, or even it is something is pending in the court. So in that case, we cannot take any action. Then under the current income tax 206, 207, notice have been issued by the registrar. Remember 206, 207 again, inspection, inquiry can be done by the registrar. The registrar has got the power. In my first lecture, we have discussed this. And the report will be submitted under 208. So that report is still awaited. Then companies against which any prosecution for an offense is pending in any court, and companies whose application for compounding is pending before the competent authority for compounding of offenses. So what is compounding, friends? Compounding is nothing but clubbing of all the penalties and a settlement offer being given by the company. A settlement offer is given by the company that let's try to settle things. Let's try to settle things. And and by giving a compounding offer. So that compounding offer should be valid under company law. Then only that compounding offer can be given. So whenever compounding is given, offer is given, probably you cannot strike off the company. So the crux is, if anything is pending apart from the normal operations which the company is carrying out, if anything is pending at any place, then it cannot be removed. Then companies which have accepted public deposit, very important, friends. Companies which have accepted public deposit, which are either outstanding or the company is in default or repayment of the same. Now, can the deposit be accepted from the member, director? Can those companies be taken to, can those companies be striked off? The answer is yes, because here it is mentioned as public deposit. Where the charges are being pending for satisfaction. Very important practically, my suggestion, friends, if the company has taken a loan and a charge is created, we all know that process, charge is created. That means in ROC, a charge is created against the asset. So whenever the loan is repaid, I think the first thing what should be done, the charges should be satisfied. Charges should be satisfied. If it is not satisfied, then it limits you from taking any further action, certain further actions. So normally we have seen in old companies, these have been missed out. And in the current law, it is a must. So please do ensure of your client that all these charges do get satisfied. For a Section 8 company, obviously, Section 8 company can never get his name removed. Something about vanishing companies. Something about vanishing companies. So the vanishing companies are, there are examples of companies which have vanished, raised funds in the market, and thereafter they've never come back. So their trading has stopped because of XYZ reasons. And those were small companies which came into the market and there were no operations, which were shady companies, shell companies, and something was wrong within the whole setup of that company. So vanishing company, any company which has been listed with the stock exchange. So the primary purpose for which this company came into the market, raised funds, was something else. So we want to track those companies. So we cannot strike them off. They should be there in the members register of companies list, which has failed to file its return with the ROC and stock exchange for a period of 2 years. Not maintaining registered office at the address notified by the ROC or stock exchange. None of its directors are traceable. That's the important aspect, friends. The directors are not located. You're not able to track them. That is the meaning of vanishing companies. So you may find that this used to happen long time back. Today, probably finding a vanishing company in the current context, which have been listed in last 7 to 10 years, probably you will rarely find any companies which are vanishing companies. But because they were then in existence about 15, 20 years back, so they still goes on. So that was 248.1, application by registrar. Now we talk about application by the company. When can a company apply for removal of the name? So the company may, after extinguishing all its liabilities, very important, by a SR or consent of 75% of the members in terms of paid up share capital, file an application in a prescribed manner to the ROC and asking the ROC to remove the name. And then on the receipt of such application, the ROC will cause a public notice to be issued in a prescribed manner. Public notice to be issued in a prescribed manner. See, Bonnie, you should understand the Section 8 companies, the purpose is totally different. It's a non-profit organization where there is no commercial purpose of doing a business. So when there is a non-profit organization for a social cause or for any specific reason, then finding out a reason to strike off is not very logical. If you want to close down, there are other ways of closing down because there is no business in those companies. So closing down is always easy in those companies. So because of the objective part, see, as we are referring to this section, you will understand that there are chances that these provisions may be utilized for some undue benefit. That is why there are so much restrictions. So for 8, because there is no such business element, that is why they have been dealt separately. So on receipt of such application, cause a public notice. So public notice will be given by the ROC that this company has applied for removal of the name. Any person in this world is having certain points to be raised or raising an objection, please do come. If any regulatory permission is required from any regulatory authority under a special act, let's say if it's a finance company, RBI permission may be required. If it's an insurance company, IRDAI permission may be required. So then permission has to be taken. See, again, Mr. Jose, here the reason is because in Section 8, you cannot define the objective as winding up because normally in the business objective, there could be that if the reasons permit, there could be winding up. So here there's no such case of winding up because it's a non-profit organization company. So once the notice is issued, the registrar may, unless cause to the contrary is shown by the company, strike off its name from the register of the companies and shall publish notice thereof in the official gazette. So again, one notice will be issued in the official gazette that this company has been struck off. So I think every 2 years, the ROC takes this exercise, of striking off and listing out the names of the company which have been struck off. They do publish a detailed notification that these are the companies which have been struck off. Now, before an order is released, how do I ensure that, yes, there is nothing in existence with the company. Everything has been paid off. So the registrar may satisfy himself that provision has been made for relation of all amount due to the company and for the payment of discharge of its liabilities. That means sufficient amount there's sufficient document which prove that, yes, the assets will be realized and liabilities will be paid off. How you will get that proof? Maybe we will take a report from the chartered accountant that this will be done along with the affidavit by the management. Yeah, this is being done. As I said, if necessary, obtain necessary undertaking. That is affidavit that this will be done. Now, what may happen? What could be the possible scenario, friends? There are scenarios, practical scenarios. Suppose you have received an income in the form of interest. And the loan which you have given, on which you have received the interest, that loan also is given back. That means all your assets have been realized. And based on that, you deposit all the liabilities. And then the company is striked off. Suddenly, after 6 months or after a year, the person who just paid the interest, maybe at that point of time, he has not deposited that TDS deducted on the interest. And maybe later on he deposits, and the same is reflected in 26 years of the company after 6 months or a year, after 1 year. By that time, the company is striked off. Now that amount is reflected in 26 years as the amount of TDS. I've already paid everything. So that amount becomes refunded to me. Now what will happen for that amount? So the rule says that notwithstanding the undertakings referred to in this subsection, the assets of the company shall be made available for the payment or discharge of all its liabilities, even after the date of order of removing the name of the company from the register of the companies. That means if there is an asset to be realized or any liability to be incurred in due course of time, even if that happens after the company name is removed, those transactions can take place. Example which I mentioned, income tax refund order which is received. The liability of every director, manager, officer exercising any power of management and every member of the company dissolved under subsection 5 shall continue and may be enforced as if the company had not been dissolved. So liability of each of the director remains there. They are not absolved from their personal liability. Now remember, this could be an exam question. If a company which is striked off, can it be wounded up under section 2 and 71? Is there a possibility? So remember, this 2 subsection 8 talks about nothing in this section shall affect the power of the tribunal to wind up a company name of which has been struck off from the ROC. So remember, even if the company's name has been struck off from the ROC, even after that, the company can be wind up. Very important, friends. This could be an MCQ or a case-based scenario, indirect question which can be asked. Can 2 processes simultaneously happen? The answer is yes. The law talks about these 2 processes. So let us have this question. The ROC was reviewing the financial statement of White Steam Private Limited, which was incorporated 8 months ago. The ROC found that the subscriber to the MOA has not paid the subscription money and not they had filed a declaration. ROC striked off the name of the company from the register of the companies. Comment upon legal compliance. So the answer is, we all know, as per the provision, if they are not paid the subscription amount within 180 days, neither they have given a declaration for the same, that the money has been paid, then the ROC can can remove the company's name not remove the company's name, but send a notice to the company and ask for the representation within 30 days. So this is subscriber and not paid the subscription amount within 180 days. The ROC shall send the company a notice stating his intention to remove the name and requesting them to send their presentation within 30 days. So the question is, what the ROC has done, he has striked up the name from the ROC. So whether he is compliant or not, compliant in the conditions, but not compliant in the process. So the process says that he has to send a notice in STK1. So until that notice is not sent, you cannot strike off the name of the company. So you need to remember first the condition and the process also. That is very important. Then only you will be able to answer it. Another question. ABC Insurance Company was incorporated from following all the legal procedure, but the company cannot commence its operation from 1 year. The members decided to get his name removed from ROC, getting 80% consent in terms of paid up share capital for removing the name. Application was filed for purpose. Determine the validity of the application. Friends, again, one is the condition. Yes, condition is because they have not commenced the operation since incorporation from 1 year has elapsed, so they are entitled. Second, they have all the process part. So first process was, yes, they have taken approval of 80% members, 75% is the requirement. So if they have taken 80% approval, so second process approval. So condition, process, condition, process. So condition, good, process, approval. But very important, friends, because being an insurance company, remember we had discussed one provision where it talks about that you have to take approval of any special authority under which this company has been created. So we need to take an approval of IRDA before we apply for striking off the company's name. So because this was not taken, or we can suggest this should be taken before application. I hope you are getting the points, friends. Hope these are points which are clear in your concept. Any doubts? If you have anything in mind, please raise your point. Yeah, so there was two reasons, Mr. Shalin. SR or consent of 75%. So here they have taken a consent of 80%. After extinguishing all his liabilities. Very important. Is that fine? So we take this break, and after this break, we will. No, penalty for what, Aniket? I did not get penalty for what? I mean, if you are giving wrong information, penalty is always there. We'll understand. There will penalty under 249, 251. We'll refer to those penalties. Penalty is yet to come. So penalty and how to restore, both the processes are left. So we'll take it after the break. Penalties and restoration. So any query, friends? Anything which you have in mind? No. So friends, when can an application cannot be filed? Under section 248. So 249 is containing restrictive provisions. When cannot you cannot file the application? Specific by the company. Specific by the company. So first, anytime in the previous 3 months, the company has changed its name or shifted its registered office from one state to another. Remember, within state it is allowed, not from interstate. Second, has made a disposable for value of property or rights held by it immediately before seizure of trade or otherwise carrying on business for the purpose of disposal for gain in the normal course of trading or otherwise carrying on of business. Simple meaning, if there is a disposal of the property or rights held by it immediately just before the business was closed on. So in that case, you cannot apply. That means there is sale of asset. You still have to hold on for a certain time period. Or you have been engaged in any other activity. That means there is some activity which is going on in the company. Otherwise, which is necessary for making an application under this section or deciding whether to do so or concluding the affairs of the company. That means any process-oriented activities being carried on, then you cannot, then it is allowed, otherwise it is not allowed. Or if there is an application at tribunal for 232 compromise arrangement and still the hearing is going. Then it is being wound up under chapter 20 of this act or under the insolvency bankruptcy code. So 5 condition, 5 mark question. 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 Penalty. I think somebody was asking about the penalty provisions. Remember, if there is a violation in respect of the application where there is some restriction, 5 restrictions, how do you remember those restrictions? One is registered office, disposal, office disposal, activity, tribunal, wind up. Then punishable with fine, which may extend to 1 lakh rupees. So this is one penalty for non-compliance or applying even after the restriction. So ACOM is a private limited company incorporated in 2013. The company deals in manufacturing process. Since May 2018, the company is not carrying on a business. In April 2020, the company shifted It's registered office from Jaipur to Ahmedabad, one state to another. On 2nd May 2020, company decided to file an application for strike of companies. According to section 249, the said act of the company will not be valid because the application can be filed only after 3 months from the date the company is shifted is registered office. Very clear. So what is going to happen once the company is notified as dissolved? Under section 250, it says that when the company stands dissolved, whether the name has been removed from the list, register of companies, it shall, on from the date mentioned in the notice, cease to operate as a company. You will cease to operate as a company. And the certificate of incorporation issued to it shall be deemed to have been cancelled from such date. But for the purpose of realization of any amount due to the company and for the payment or discharge of its liabilities, remember this subsection will not have any effect. In the sense the company will be continued to be in operation if there is amount which is to be collected and if there is amount to be paid. Then you would always question, so then why do strike off when there is some still amount to be collected? Remember, friend, as on the date of removal, probably there's nothing on the asset and the liability. But after the striking off, if there is an amount which is due, is realized, or comes to know that this amount has to be realized, then later on nobody can raise an objection because the company is dissolved, I will not make the payment. Nobody can say that point, no, I'm not going to the payment, I'm not going to make the payment because the company still is not in existence. Then you can always show this section 250. It says that the company is not in existence. Okay, agreed, no problem in that. But remember, because of if I have to collect, for that purpose, the company is in its existence. So you cannot deny the obligation to pay the amount to the company which has been struck off. Now, there's another penalty. I think, again, somebody asked about the penalty part. Yes, Mr. Niket. So another penalty in case of fraud. So where it is found that the application under company by a company under subsection 2 has been made with an object of evading the liabilities of the company or with an intention to deceive the creditors, to defraud any person. The person in charge of the management of the company shall be jointly and severally liable to any person who had incurred loss or damage, be punishable with fraud under section 447. So directly it links to 447. As I said, 447 is a holistic section for fraud. Somewhere or the other it will come into picture. Omnipresent. So there are two penalties applied to the company, which is applying under 248 subsection 2 on its own, and the intention is to defraud the creditors. This is very important section. Restoration. Now, restoration is what? Any person agreed by an order of the registrar. Any person. Remember, notifying a company as dissolved under section 248, it may file an appeal to the tribunal within a period of 3 years from the date of order. Remember, 3 years is the time limit. And if the tribunal is of the opinion that the removal of the name of the company from the ROC is not justified in view of the absence of any of the grounds on which the order was passed by the registrar, it may order the restoration of the name of the company. So that means you have to satisfy the tribunal. Because there was no grounds on which the order was passed by the registrar under 248. It was not about 248 1 or 2. They are covering both the aspects, 248. That means even if the name was removed by the registrar, so this is a case-based situation, friends. The question may be asked in a sense that the company's name was removed by the registrar, and thereafter the person is filing an application, an appeal. Remember, he has to file an appeal. Appeal is against always an initial order, remember. So they are filing an appeal, whether that appeal will be valid or not. So it is immaterial whether it is being, the company's name has been struck off by registrar or by the company on the request of the company. It is immaterial. On both the cases, you can go and file an appeal. Restoration by the registrar. That means the registrar on its own can also restore the name. So first is file an appeal. Good, you file an appeal, go. Where? To the tribunal. And tribunal feels that the grounds were not justified enough to remove the name. Then it will order. Second, registrar feels that there has been some mistake, inadvertently or on the basis of incorrect information furnished by the company or its directors. So inadvertently or on the basis of incorrect information. If there is incorrect information, he can proceed for what? He can proceed for fraud also. 251, which requires restoration in the register of the companies. He may, within a period of 3 years from the date of passing of the order, dissolving the company under section 248, file an application before the tribunal seeking restoration of name of such company. So again, remember, the registrar on its own cannot restore the company. An order of tribunal is required to restore the company. That is the important thing. That is the important thing. Then the copy of the order passed by the tribunal shall be filed by the company with the registrar within 30 days from the date of the order, and on the receipt of the order, the registrar then will restore the company's name and issue a fresh certificate of incorporation. So a new certificate of incorporation will be presented. So friends, a detailed process. Again, in tribunal, it will take time. It does take time because hearing will take place, and after due hearing, then lot of action is heard at the courtroom if there is any objection by the company. But if there is no objection, very well, they can always file. The tribunal will pass the order, and accordingly, the company will be restored. Then, very important. Now, there are 3 story restoration. One is any person can file. Second is the registrar can file an appeal. Remember, registrar will file an application. Remember, registrar will file an application. May file an appeal. Remember, the tribunal on an application made by the company member, creditor or workman. 4 people have been identified. Company member, creditor or workman. 4 people have been identified. Before the expiry of 20 years from the publication in the official gazette of the notice under subsection 5 up to section 248, may, if satisfied that the company was at the time of its name being struck off carrying on business or in operation, and or otherwise it is just that the name of the company be restored to the register of companies, make an application, give the approval. Yes, the company may be restored. the company may be restored. Now, friends, the difference between the three sections. First was by any person. So here it is not by any person, but the 4% have been classified. Second is that aggrieved person will file an appeal. An appeal is against the original order. Here it is an application, not against the original order, but 20 years from the date of the publication in the official gazette, that the company's name has been struck off. Proving that the business or the company was in operation. Or you may prove that the company had an asset. See, it happens practically. Let me tell you, it happens in law. It actually happens in practical scenario. The company's name has been struck off by ROC. And there was maybe, let's say, a dispute between the management and they were not filing the returns. The ROC struck off their names. And let's say 10 years have passed by where there no returns have been filed. But suddenly there was a light from the God to the promoters, to the fighting promoters. And suddenly one day they realize that they have committed a big mistake. So they join hands together and say, okay, let us restart the company. As you know, all the brothers meet or friends meet after a long time, and they think that we should restart the business, which was they were running. Or even if they want to start fresh, maybe they want to relook at their old company. But when they approach the consultant says that, chartered accountant says that, sorry guys, the company is not in existence anymore. But they feel, oh, why? How? Why? How? These are the questions raised. But what is the intention? Because they know that the company which was in operation had a huge land bank, huge asset lying in the company's name, which they cannot dispose of personally because of law does not allow. Now they want to dispose of the land. The company is not in existence. How do we take it forward? So the only way out is they will come and make an application, the company, the member, before the tribunal and saying that the company had land. And because there was a land, therefore there is some asset which is realizable. So therefore they want to restore the name. So these are practical scenarios which happen to the company. Telling him your So after 3 years, ROC is not allowed. Within 20 years, the company member, creditor, or workman. There may be other scenarios, friends, where the company has been struck off by the registrar because it is not in operations for whatever conditions, 2 years. So let's say, for example, Company is not carrying on business for a period of 2 immediately financial years. For this is one of the condition, right? So based on this condition, condition C, the registrar has reasonable cause to believe that because there are no business operations which have been carried on, so the company gets struck off by the registrar. And there have been instances where the companies have been struck off because of the action taken by registrar, because the company was not filing its business returns under Section 92. Section 92, all the returns. So therefore, the ROC took the suo motu action and struck off the company's name. So thereafter, the management comes into picture. The income tax department has raised a demand. Maybe the management is not interested in restoration of the name, but the income tax has raised a demand. And you always know that the income tax does the assessment after some time period. And later on, the income tax has raised a demand, but it finds that the company has been struck off. Therefore, it may apply to the tribunal as a what? Creditor, or any person agreed under 252(1). If 3 years have just elapsed, if more than 3 years, then as a creditor it may apply. The income tax department comes to the tribunal and says that please restore this company under 248(1), 248(3). Hope you are getting the point. Any questions which you have in mind? These days. So these are the practical scenarios under which we can restore the company. So striking off 248, 252, two important sections, 248, 252, along with restriction under 249. So 248, how to strike off, 252, how to restore, with 249 as conditions where you cannot strike off. Conditions where you cannot strike off by the company. By the company. So if you remember these three sections, and if there's a 4 to 6 mark question, I'm sure you will be able to answer it. 100% is a surety. So only 3 sections, though the chances of question coming from this particular point or valuation or dormant company or government company or otherwise is very low. But even if it is low, because there are only 3 sections, I would always suggest, please learn this section more dedicatedly in comparison to the sections from 160 to 200. Now, government companies and annual reports on government companies. Government companies and annual report of government companies. Again, straightforward section, no complication. So as per section 245, government company means any company which is not less than holding 51% of the paid up share capital by the say both of equity and preference. It is held by the central government or by any state government or governments or partly by central government, partly by one or more state government, and includes a company which is a subsidiary of such government company. So that means it includes every type of company wherever government is involved. In consortium, standalone, combination of state government, combination of central and state government, all is allowed. So that is defined as what the government company. Now, what does 394 talks about? 394 talks about the obligations of publishing of the annual report. Obligations of publishing the publicizing the annual report. So where the central government is a member of a government company, central government is a member of the government company, the central government shall cause an annual report on the working and the affairs of the company to be prepared within 3 months of its AGM, before which the comments given by the CAG, Controller and Auditor General of India, and audit report are placed under provisions of subsection 6 of the section 143, which talks about the points mentioned by the CAG, the auditor. And as soon as may be after such preparation laid before both the houses, Parliament, together with a copy of the audit report and comments upon a supplement to the audit report made by the Controller and Auditor General of India. So first, they should be prepared within 3 months of its AGM. After that, the comments of the Controller and Auditor General of India will be made. And thereafter, it will be laid before both the houses of the Parliament together. Along with the comments made by the CAG. Where the central government is not a member of the government company. So every state government which is a member of that company, or where only one state government is a member of the company, that state government shall cause an annual report on the working and the affairs of the company to be prepared within the time specified in the section 394. Then the responsibility lies on the state government. So state government shall cause an annual report on the working and the affairs. And thereafter, it will be presented before both the houses of the state legislature together with a copy of the audit report and the comments thereof. So this is very simple, friends. Government company, restoration, and valuation. So today we'll just have a brief introduction of Nidhi companies, and then we'll conclude today's class. And in the next class, I will cover Nidhi companies, dormant company, and fraud and inspection, and few questions. Nidhi company is a very broad concept, again covering many rules along with the section part. So miscellaneous provision being a very short chapter, again being a short chapter, you should take advantage of the same. Now, when you refer to Nidhi companies, you will come to know that it's a company where the central government will notify that it is Nidhi companies. There have been few amendments in the Nidhi rules. Along the amendment have been made in 2020, and thereafter the amendment has been made in 2022 also. So there are few amendments which have been made to Nidhi companies. And both the amendments, obviously 2020 is applicable, 2022 is also applicable for your next attempt, that is May attempt. Now, Nidhi companies are similar to banking companies, very small, and because it is a banking company, we know that they will accept deposits. So there are rules of accepting deposits, there are rules of giving the loans. They are similar to, chit funds or cooperative banks which collect money from the members and then return or give loan to the members. So the prescribed rules are given that who can be a member, on what conditions they can take the money from the member, on what conditions they can give the loan to the members, and what is the rate of interest they can charge, how much deposit they can accept, where can they invest their money, what is about the auditor, what is the condition of creating that nidhi company, what is the minimum capital which is required. All these are points which are covered in this. Again, the question arises, friends, do I need to spend so much of time for that 4 marks? Now, this is a place where I would again suggest that this is a question mark. But for restoration, for valuation, for government company, there's no question mark. That is a tick mark where you have to do it. You should do it. But for topics like nidhi company, if you have sufficient time, enough patience, balancing the whole approach, you can always put it in the list. You can prioritize and then prepare the list. Where do I need to put this particular topic? So, nidhi companies, section 406, you just cover the definition part and then conclude for today's class. Nidhi or mutual benefit society, as I said, is means a company which central government may notify, declare to be nidhi, or a mutual benefit society. And the central government by notification in the official gazette direct that any of the provisions of this act specified in the notification shall not apply to any nidhi or mutual benefit society. So that means for a company to be classified as nidhi, the central government has to give a notification, clarification that this company is a nidhi, and whenever they come, it is applied as the name is given as nidhi. So they have to mention it in their name, a nidhi company. Plus the definition, which talks about the concept of doubtful asset, loss asset, net owned funds, and nidhi and the substandard asset. So initially the rules were that the share capital should have 5 lakhs and they cannot issue preference shares, which has changed in the current context. We'll cover up those rules in the next class. So remember, every company incorporated as nidhi shall have the last words nidhi limited as parts of its name. Nidhi Limited as part of its name. So friends, we will conclude today's class here and we'll cover up the rest of the provisions in the next class, covering nidhi, because these are small topics. So maybe I'll take further, not major time in the next class also. Sir. Any questions which you have? If you want to raise, please raise your point. Okay, there are a few questions which I missed out. After strike off, a company can be wound up, but after wound up, a company cannot be strike off. Yes, Mr. Baumik, you are absolutely perfect. I think a company which has been wound up, they cannot be strike off because winding up itself leads to dissolution, and there is no chance of again restoring it except for 356, which is very rare. So perfectly said, Mr. Baumik. Strike-off company can be wound up, but a wound-up company cannot be strike-off. Challenging private limited company is a subsidiary, but not a wholly owned subsidiary of government company. Is PQ Limited a government company? Is that the question, Mr. Shalin? Are you talking about by the definition part? PQ Limited is a subsidiary, but not a wholly owned. So it does not matter if it's a wholly owned subsidiary or partly owned. It is given, the word is subsidiary company. So it is immaterial whether it is holding of a wholly owned or not. Is it clear, Mr. Shalin? Any further questions? No? Okay, so we conclude today's class. Thank you, and see you in the next class with the remaining topics. Ayaz sir,